Brisbane's property market is running out of gas and nobody seems to be talking about it just yet. This time last year, the auction clearance rate in Brisbane was nearly 70%. In the first week of July this year, clearances plunged to 24%, according to the latest Cotality style figures. So in that 12 months, one of the hottest property markets, I heard about it everywhere, as I'm sure you did too, went from 3 out of 4 homes selling under the hammer to just 1 in 4. This looks like a market in distress, or at least slowing down. If you own a home, have a mortgage, or waiting to buy, the next 6 months decide what your biggest asset is worth. And this doesn't just apply to Brisbane. Nationally, auction clearance rates dropped below 50% in June 2026 for the first time since the COVID lockdowns hit in April 2020. Roughly $185 billion in combined Sydney and Melbourne market value was wiped out in the June quarter alone. Prices in our 2 biggest markets in the country are falling every month and have done for the last few months in a row. This is happening after the RBA raised interest rates 3 times in early 2026, right as new tax rules made property investing less attractive, thanks Labor government, and it all ties up with the 18-year property cycle that's been repeating ever since the 1800s. So in this video, I'll be going through the 4 major things: the auction market cracking, the rate hikes nobody saw coming in 2026, the negative gearing shock that just chased investors out the door, and how all of this lines up almost perfectly with the 18-year real estate cycle. Okay, let's get started with the auction room, which is the clearest crack in the property market thus far. Typically, above 75% clearance rate is a strong seller's market. That means sellers can ask for whatever price they want. Between 65 and 75% is roughly balanced. Below 60% means buyers are running the show or getting close to it. Now, national clearance is sitting around 50%, so that's well below the 60% level. Sydney bottomed at 47% in late June. Adelaide, which was a genuine star performer earlier this year, dropped to 45% earlier in July. And what we've seen, it gets a little worse here. Preliminary clearance rates are what agents report first, and they tend to be overstated by 3 to 5% versus the final confirmed number. For example, when the headline says 50%, the real market might already be sitting in the mid-40s. Auction clearance rate dropping can also lead to lower property prices. The national median dwelling price peaked at $944,000 in March of this year, and by the end of June, it had slipped back to $937,000. So we have a local short-term top thus far in the real estate market in Australia. June recorded the biggest monthly national fall since December 2022. That was down 0.4%. Doesn't sound like much yet, but we'll get to the further figures. In the month to mid-July, the 5-city aggregate fell 0.9%, led by Sydney down 1.4% and Melbourne down 1.3%. Some analysts are now calling this the sharpest decline in 40 years. Not us just yet. On the surface, it's clear to see what's happening, but I've had some pushback on my views so far. One common question I get is, if Australia has a genuine housing shortage, how can prices possibly be falling? This correction isn't driven by simple supply and demand. It's driven entirely by the cost of credit, and credit is exactly where these things get worse. Rewind to the start of 2026. Most people expected the RBA to keep cutting interest rates like they did in 2025. Instead, the RBA did the opposite with 3 rate hikes. We talked about this on my main channel due to building pressures towards a peak of a cycle. Inflation was next. This is what we said months ago. That dragged the cash rate from 3.6% all the way back up to 4.35%, completely unwinding the previous year's cuts. The March hike was marginally agreed on with a 5-4 internal vote. That's with the RBA. That basically means the RBA board was split down the middle, half fighting for inflation, half terrified of tipping the economy into recession. Since then, the headline inflation eased to 4% in May, mostly because fuel got cheaper. But the core number, which is what the RBA watches, rose to 3.6%. So the one number that would get them the rate cut is moving in the wrong direction for that rate cut. So some analysts and future markets see a possible further move to around 4.6, which is essentially one more increase, though the CBA and ANZ reckon the cash rate may have already peaked around 4.35. Most forecasts show no cuts before 2027, so maybe there's a little good news in it here for the remainder of 26. For 2 decades, the deal was simple. Things get bad, the central bank cuts, your repayments get easier. In this new regime, banks are hiking, repayments are getting harder, and property demand is falling. That brings us to the second issue, the one that makes this cycle different from any downturn you can remember. It's not to say that this time is different, it's just that we're seeing new narratives pop up in the same cycle, which is very typical of cycles. On budget night, May 12th, 2026, the government dropped a bombshell on the property investors. Negative gearing is now restricted to newly built dwellings only. For established properties bought after 7:30 p.m. that night, negative gearing survives an interim period but gets phased out entirely from July 1st, 2027. After that, those losses get quarantined, meaning you can only carry them forward against future rent or capital gains, not your salary. They also scrapped the 50% capital gains discount, replacing it with cost-based indexation and a 30% minimum tax rate. For 40 years, touching negative gearing was considered political suicide. The fact they have done it tells you the political class now sees this as a full-blown emergency, or they think they've got a new answer to the same old problems. As you can imagine, the market reaction was instant. Investor mortgage demand reportedly fell as much as 50% in some segments. Here's why that matters. In normal corrections, investors are the buyers who step in and catch the falling knife, which somewhat supports the price. This time, policy is removing them right as the market seems to be rolling over. CBA cut its 2026 price growth forecast to 3%, straight down from 5%, and named this policy as the reason. I don't know if the government's going to like that the bank is saying that they're the problem. Anyway, Westpac now expects flat prices for the entire calendar year. Now, before we go further, none of this fully makes sense as isolated events. The rate hikes, the auction collapse, and the tax rate only click into place when you see the pattern underneath them. Real estate moves in a rhythm of roughly 18.6 years, 14 years up, then 4 years down. Fred Harrison mapped it in the UK and Phil Anderson refined it using US land data going back over 2 centuries. It's proven data for over 200 years, which led to Harrison calling the 2008 crash 3 years before it came. And not every year, just that specific year. Now, Anderson has had 2025 and 2026 circled as the peak of this window. So we've been looking at with the 18-year cycle for over a decade. The final stretch of the boom has a name. It's called the winner's curse. It's a phase where the last buyers pay the highest price with the thinnest deposits at the worst possible moment in the cycle. There's a few other things to the winner's curse, but we'll leave that for future videos. 2026 is already giving us a massive winner's curse warning. Total outstanding housing loans hit $2.54 trillion in January 2026. That's up 6.7% year on year. This means debt is still growing while prices are falling. It's a classic late cycle warning sign when credit is stretched to its absolute limit right as the asset turns. In this case, it's turning down. Australia carries one of the highest household debt to income loads in the entire OECD. And unlike the US, Australia doesn't get to print the world's reserve currency. We have to earn our US dollars. That means our credit cycle is far more exposed to global tightening and external shocks. So when the shocks come, it'll affect our property market more than the US. Now, you might not have seen that in prior cycles, but we've had other reasons for that during those cycles. Things like the commodity boom cycle that we have been going through. I'll talk more about that in future videos, but let's get back to this story. So now, let me be fair because I'm not here to sell the doom. There's an alternative case. The SQM argues a full crash is unlikely because the structural supply shortage generally does support prices underneath. They've got a point. Building approvals are falling. May approvals came in at about 17,000 with multi-unit approvals down 10.4%. We're approving around 9 dwellings per 1,000 people, worse than the 12 per 1,000 that we managed back in 2015. Meanwhile, net overseas migration hit 1.4 million over the last 3.5 years. So the shortage is real and rents prove it, up 7.6% year on year. This is crazy, to $1,150 a week. Unlike the US oversupply bust in 2008, this is a credit and policy correction layered on top of a genuine scarcity. So that's what makes it a little more complex and honestly a little bit more dangerous than the textbook crash. When you look closer, the bad outweighs the good. Signal 1, auctions clearing below 50% nationally for the first time since the pandemic. Signal 2 is prices actively falling in Sydney and Melbourne while the cash rate sits at the 2026 high. Signal 3, a tax regime rewritten specifically to drive investors out of established properties. 3 independent forces which point towards a property market crash. And underneath all of it, unemployment hit 4.5% in April 2026, and that's the highest level since November 2021. Yes, there's a housing shortage in nominal terms, but mortgage stress is climbing fast. Roy Morgan puts 26.8% of mortgage holders at risk as of March. That's up 1.447 million people, up sharply from a 3-year low just 2 months earlier. People generally defaulting as of the latest data are still near 1%, which tells me we might be a little early here. Households don't miss their mortgage first payments. They cut the groceries first, they cancel the holidays, drain the savings, they max the cards, and they keep the loan current. The bank can already see it. Big Four profits fell 2.1% in the first half, and credit loss provisions rose 3.6%. They're bracing for impact, and it looks like the system is preparing for defaults it can already see coming. So it's probably not a bad thing if they can see it coming. It gives them time to prepare. Roy Morgan data already shows mortgage stress climbing sharply, hitting 29% by May. And further rate rises towards that 4.6% level analysts are discussing could push it higher still into GFC era territory. It's important that you keep an eye out for the unemployment number. If we see continuous increase throughout the year, the day-to-day financial stress of the consumer will become a full-blown crisis. I'm not telling you the whole thing collapses tomorrow. This grinds out over years, one cohort of borrowers at a time. And some of these corrections won't even show up as falling prices. Obviously, and I hope you already know this, I'm not your financial advisor, and I could be wrong. The shortage could hold prices up longer than the bears expect. I think it's important to look at both sides of the argument. That's at least what I do as an investor, and those who I look up to also do. There's not just one side of the equation. But I'd rather be prepared and a bit early, not completely early, but a bit early, than caught out and right. So here's what to actually do with the information. If you own a home and your repayments are comfortable, don't panic sell, but don't bank on rate cuts arriving to rescue you. Run your numbers against an increase, say 4.6 or 5%. You do this by opening your banking app, find your current rate, and use the mortgage calculator to work out what your monthly repayments become at those higher bank rates. If that number scares you, start setting aside the differences now, every month before the rate arrives. If you're stretched, you bought near the top with a thin deposit in Sydney, Melbourne, maybe in Brisbane or Perth, this is the moment to build a cash buffer and stress test your budget before the market forces the decision for you. Start with 3 months of mortgage repayments sitting in an offset account or savings. It could be difficult, but it's better to be prepared and have some nice holiday money in the long run if things don't turn out like this. If you're a saver sitting in cash waiting to buy, patience is the play. Don't catch a falling knife at the peak, but I would say get out there and start looking at open homes and talking with agents. Get out there so that you can see what's happening in the market. Don't wait for the exact time that you want to buy. At least that's what I've done over the last 20 years. It pays to be in the market and see what's going on, even if you're not ready that day to buy. If you're an investor, understand the tax shelter you are relying on is being switched off. So don't overlever into a market where your safety net just got removed. Overall, you should watch unemployment, watch the arrears numbers, and watch what the RBA does going into 2027. Those will confirm whether we're right, early, or wrong. Now, I want to hear from you guys. Where does this resolve first? Does the RBA cave and cut in 2027 to save stretched borrowers, even with core inflation still sticky? Or does unemployment keep climbing until mortgage stress finally tips into real arrears and the deeper leg down begins? And which market breaks hardest? Sydney, Melbourne, Perth? Or does Brisbane's auctions collapse the spread to the next price declines? Drop your call in the comments section. I'll be reading every single one of them and replying to as many as I possibly can. If this video helped you, please hit the like button, subscribe to the channel. I cover charts, stocks, commodities, Bitcoin over on my other channel, Jason Pizzino. There's a link to that in the video description too. So I'll see you guys at the next video. And until then, take care and peace out.